Now, we've seen now that we can have these tables, we use the Bellman equation, and then we approximate these tables with neural networks. Now, how do we implement this? This is very interesting. And the first thing is that we use something which is called gamification of trading. So effectively turn each trade into a separate computer game. So we see each trade effectively as a computer game. Now, when we implement this, one of the difficult bits is to find the right reward function. So I've already talked about this. I have said that the reward function could be just the profit and loss, but that's not necessarily always a good choice of a reward function. And I explain a little bit later why that is in more detail. Now, I've seen some people ask me a few questions here. Usually when I run this as a webinar for QuantInsti, I often answer the questions during my talk. However, today, because we have limited time, I will actually answer these questions after our talk. So if you have some questions, please bear with me. And what I would really prefer is if you hold off a little bit with your question and then send me the question at the end of my talk, and then I can answer them. There will be plenty of time to answer some of your questions. Okay, so when we implement this, we really need to find the right reward function. Then we also need to find the right inputs to define our state. So of course, we could use a wide variety of inputs. A very typical example in trading are technical indicators, but we could also use all sorts of alternative data, sentiment data, results from satellite images, and on and on and on. And of course, some of them will be valuable and others will not be valuable. Now, if we only have inputs that don't really have much of a predictive value, then we also won't be able to make good trading decisions, of course. And we follow the principle rubbish in, rubbish out. So when you use those, of course, make sure that you actually create inputs that have some sort of positive predictive behavior. Okay, and then what we need to do is, once we have built a system, we need to test the system for known behavior. So for example, before we apply the system to use in market data, what we want to do is we want to first test the system with other things such as sine waves or random price data, or just random functions, in order to test whether our system actually behaves the way it's supposed to behave given the known inputs. Then we also need to choose the type of neural network that we would use. We need to choose the size of our neural network. And finally, we also need to choose the cost function of our neural network, which is really, in some sense, dependent on which reward function that we choose. Okay, so let's talk a little bit about gamification, and I've already explained a little bit about this. So in a normal computer game, we have a state, which is what we see on the screen. We have a what we call a policy, or our actions, which is our movement of the cursor. So our movement of the cursor is basically up or down in this case, or stay where it is. And then the policy, of course, means why we would move the cursor in one direction. And then finally, we get a reward, and we can see here these numbers. Usually when we score a point, we get a reward based on this score. And so for trading, I already explained that the equivalent would be something like in the state, historical and current prices, technical data, and alternative data sources, buy, sell, and hold. And then finally, our reward would be the P&L of our trade when we exit. So how do we train the system? So first of all, when we start training a system like this, what happens is the system will just randomly make decisions. It won't know anything about what's happening at the beginning. And so it makes a decision, for example, to enter a trade, and then it holds the trade for a while. And then at some point, it just makes a decision to exit a trade. And there's a reward at the end of this. And then our reinforcement learner will use the Bellman equation to basically label our observations with retroactive labeling according to the equation we've seen before. But then over time, the more we apply this sort of retroactive labeling and the more we update our tables, which are approximated by our neural networks, slowly but steadily, the machine will learn to make better and better trading decisions. So in the simplest case, we do this for just one instrument, and this is really what we're discussing today. So we just say want to trade one instrument, let's say the S&P 500 index, the SPY in the US. So we feed the price data, we apply our system, we step through time, and then bit by bit, the machine will learn how to trade this. Another way to do this also is rather than stepping through time sequentially where the machine learns, we can also just take our training price series and then just randomly enter at some point in this price series, play a game, and then exit, and then randomly enter the price series at a different point, run another game, and then exit, and so on. So rather than running through the price series sequentially, we can just enter and exit at random points for training. So which one of those two you choose is really up to you. Both are really possible and both work. Um, and there is no really good or bad. It really depends what your preferences are and how you would do it. So I talked about the difficulty of designing a reward function. So there is really many ways to build a reward function. And obviously the easiest would be just to use a pure percentage P&L. So basically just the difference between the exit price and the entry price divided by the entry price. So just what is your percentage profit? But quite often this is not necessarily the ideal way to build a reward function. Why is this? Because if we use pure P&L, then the machine could just decide to get into a buy and hold state and just basically decide not to exit the trade anymore at all, but just buy and hold. So for example, if we had the US SPY index ETF, which has basically been going up since 2009 for a long time, your reinforcement learner might decide, well, the best strategy really is to buy and hold, which is not necessarily a bad decision to make. But sometimes this is not really what we want. Perhaps we want to trade a lot more. So another reward function we could choose, for example, is just simply rather than pure P&L on exit, we choose how much profit did we make per tick. So let's say rather than maximizing the total P&L at the end, we maximize the profit that we make at every time step. Another way to determine a reward function is to use the Sharpe ratio, also called the risk-adjusted return. So we might make a profit, but the risk during this trade was extremely high. So we're not actually really happy with that trade because we exposed ourselves to a lot of risk. So rather than using pro profit, we basically use a risk-adjusted return, which means we use the standard deviation of all our profits at each tick divided by the standard deviation of these returns at each tick. And that gives us the Sharpe ratio. And that can often be a much better way to determine a good trade. Then another way to design a reward function is to punish our learning engine for long hold times. So as I said, we might just get into a buy and hold regime, but we don't want this. So we somehow use our pure P&L, for example, but then for every time step that we stay longer in a trade than we would like to be in this trade, we punish our P&L by some value or another. Another way is to punish our function for drawdowns. So if we have a big drawdown during our trade, we could introduce some sort of punishment for that, which is really in some sense similar to the Sharpe ratio. Another way to do the reward function is just having a binary win and loss. So for example, if we win, we choose to give a reward of +1. If we lose, we give a reward of -1. And then there's some more complex reward functions as well. So for example, this one assigned categorical. So instead of using just pure P&L, we split our P&L into different categories, in basically P&L bands. So for example, the first $100 P&L is band 1, the second $100 is band 2, and so equally, if we lose $100 or between $0 and $100, we are band -1. If we lose -100 to -$200, we are in band -2. And then finally, we could do the same with the categorical bands, but instead of that, we use exponential. So rather than using some sort of signage, we could say, well, if we have really small numbers here in our win and loss, so if we have really big negative values, then we will basically be in the 0 band. But if we have really high P&Ls, we will be in a much higher positive band. So none of these solutions is better than the other, but it really depends on your own work and how you optimize your system to find the right reward function that works for you and the style of trading that you would like to use. All right, so the next step is what features should we use for our trading? And so there's many things that we could look at. So one of the most obvious ones is, for example, open, high, low, close, and volume values. We could also say, for example, candlestick patterns. So let's say we would like to base our trading decision based on the open, high, low, close values or the candlestick patterns of the last n candlesticks in our trade. So for example, here we see, let's say, this candlestick pattern, and then we say, well, if we see this, we have a big drop in price, and if we see this candlestick pattern, we might assign that we have a really big drawdown in price at this point. Then the next is technical indicators. Of course, we all know the technical indicators. So for example, the difference between two moving averages, as we can see here, or other technical indicators like the relative strength index, for example, and all the others that you have probably heard of. Some interesting features also are time of the day of the week, or time of the year. So for example, if all things being equal, we take a trade at the beginning of the day, that might have a different outcome than if we take the same trade or with exactly the same state otherwise at the end of the day. So time of the day and so on, they could be really important input features. Then another one are different time granularities. So let's say we have as our state technical indicators. We could have these technical indicators on minute bars. We could have them on hourly bars, but we could also have them, say, on daily bars. And so all these different granularities, they produce different results. And even let's say we have the relative strength index, this may give us a different value at the 1 minute granularity than on the 1 day granularity, obviously. So we will get different types of information with the same technical indicators, for example, at different granularities. And then, of course, we could do the same inputting the prices and technical indicators for other instruments. So, for example, if we use the SPY ETF, we might be interested to also input the interest rates, the price of gold, the price of oil, and so on as other inputs to our state. And then, of course, as I mentioned before, alternative data such as sentiment, maybe you know things like satellite images and so on. And so from all of these, we can construct a state. And don't forget that state is quite a complex input feature, and it's in some ways similar to what we would input when we see a computer game. So the sum total of this is equivalent to when we look at a computer screen in a computer game. And based on the sum total of this, our machine makes the trading decision. All right. Then in the next step, how do we test our reinforcement learner? So when I build reinforcement learning machines, I want to know, first of all, if they work at all. So I have a series of tests that I apply before I even use price data. And the first one that I normally use is a clean sine wave. So I put this clean sine wave in rather than price data. And then I do all the calculations and basically build my state based on the sine wave. And normally what I would expect is very quickly my reinforcement learning machine will learn how this sine wave works and very quickly start becoming very profitable. And because a sine wave is obviously very clearly predictable and easy to understand for reinforcement learning machine. Then in the next step, for example, I could apply a trend curves, and again, I should see very quickly positive results from my reinforcement learning machine because we are obviously in a trend and the reinforcement learner will pick this up very fast. Then on the other hand, I also will apply something called a random walk, or like basically a randomized price series where I don't have any structure in it other than just randomness. And with this, we would normally not see the machine making consistent profits. And so if the machine makes a consistent profit with a randomized time series, then usually that means that something in our coding isn't correct. And we probably have to go back and figure out what the problem is. Then here we could also input different types of autocorrelations. Um, then what I also like to do is I add noise to my clean test curves. So for example, instead of using a clean sine wave or a clean trend curve, I use a noisy sine wave or noisy trend curve. And then finally, we could also input recurring patterns. So for example, we could input recurring chart patterns in our test system that the machine may or may not pick up and then trade on it. Okay, then the next question is, what type of neural network should I use? So In most of my work, I use just standard neural networks, but there's also the possibility to use convolutional neural networks, and convolutional neural networks are often used in image processing, or LSTMs, which means long or short-term memory neural networks. LSTMs are often really good in dealing with time series. However, the problem with LSTMs is that the time series that it likes dealing with should be stationary, and this is often not the case for financial data. So in my own work experience, I find LSTM don't really show much benefit. They're not worse than standard neural networks, but they don't usually provide a benefit for reinforcement learning. And the same, in fact, is actually true for convolutional neural networks. Now, of course, what I'm building may not be ideal, and I'm not, in that sense, a machine learning guru. I'm first of all a trader, and I'm operating in the financial markets to make profit. And I use all these algorithms as tools, and I usually apply the things that work and don't take too much computational effort and just function in the way that I want them to function. So in my experience, simple neural networks are just sufficient for what we're trying to do. All right, so now let me show you some results. And I talked about the testing phase. And so this curve, for example, is when we apply a sine wave with no, and a trend with no noise. So you can see here, at first, this is actually at first where we apply a sine wave, and then approximately around here, we apply a trend. And this is really interesting. So at first, the machine starts learning, and it doesn't actually make much profit. So it's not doing very well because it's still in a stage where it tries to figure out what's actually happening. And then at some point, it starts picking up the sine wave, and then once it's learned the sine wave, it consistently starts making profit. And then when we have a transition over to the trend, which is around this halfway mark, it actually very easily transitions to trading a trend as well, and keeps making consistent profit. Now, of course, these curves are very idealized because they don't have any noise, and so unfortunately, the reality is not as good as this. And we can see this here if we apply a significant amount of noise to the sine wave, which is shown in this box, then our reinforcement learning machine will already have a much harder time to learn and to trade. And we can see this here. So quite this amount of noise, we can see that the machine already starts struggling to learn what's happening in this scenario. The problem, of course, with neural networks is that they very easily overfit, which means that neural networks actually start learning the noise rather than the signal. So that can be a hard thing. So here, similar, we have a trend. We have a really strongly upward trending price curve, but we really add a lot of noise into the daily trend line. So whilst the trend is clearly up over periods of time, every day has actually a significant amount of noise. And again, you can see that our reinforcement learner really struggles to learn this if the noise gets, or if the signal to noise ratio gets worse and worse and worse, it will just learn the noise rather than the signal. And that is one of the big problems in reinforcement learning, the fact that we can't really necessarily, or the machine can't really easily distinguish between the signal and the noise unless we do something about that. Okay, so now this is interesting. So what I've done here is rather than putting in the noisy price curve, I actually made the machine learn a 5-period simple moving average of the price curve. So what I did is really I took some of the noise out of our price curve. It's actually not a very big moving average, 5 periods. It's quite small, so it smoothed it just a tiny little bit. But we can see that even with that little smoothing, which when you actually look at the price curve overall, you won't even be able to see that the difference between the smoothed price and the actual price. Um, but what we can see here is that the reinforcement learning machine does a much better job in actually making profitable trading decisions. And perhaps when you build those machines, that little bit can give you a good hint on when you build your own machine, what you should be looking at in order to make your reinforcement learning work well for you. So this is one of the really interesting results that we can see. Um, so now that we've seen some results here, I want to talk about a few challenges that we can see in reinforcement learning. And one of them is that financial time series are clearly very noisy, and they will give us a hard time. The other problem is that financial systems are generally very dynamic. So the rules often keep changing. So there could be regulatory rules, market rules. So for example, to transition from pit trading or open outcry trading to electronic trading and so on. Then we have changes in market regimes, for example, from trending to mean reverting. Um, and one of the problems that we have with when we use neural networks is that we get this problem of local minima, which are really hard to escape. So our once our machine has learned a specific market regime or specific market behavior, then when the market behavior changes, it will sometimes hard for our reinforcement learning machine to get out of this and actually learn a new behavior. Another problem with reinforcement learning is complex. So there's quite a few hyperparameters that we need to tune, which can be quite complex. And then finally, our reinforcement learning is quite simple and efficient. So we need a lot of training data, but on the other hand, training data, meaning market data, are usually quite sparse. We don't have an endless amount of market data available. So that's why training can sometimes be quite challenging as well. Now, finally, here we see a full simulation. And this is effectively our reinforcement learning with a really straightforward P&L reward function. And what you can see here, this is the US market, the SPY. What you can see is that it just gets into a very typical buy and hold pattern, which is actually not too bad, because what it tells us is, hey, buy and hold pattern is quite a profitable trading strategy on the US market, but it may not be really what we want. So if we see this, we may choose to build a different reward function or use different input features, for example. So what are the lessons that we've learned so far from this? Reinforcement learning overfits very easily. It mostly learns very basic market patterns. So what we often see is with reinforcement learning, it doesn't necessarily converge on learning very complex behaviors, but oftentimes neural networks are a little bit dumb and they learn very basic market patterns. And so they only really act on those really basic ideas, which is not often what we want. And we can overcome this with building more complex neural networks. But then again, if we do that, we can easily overfit the noise rather than the signals. So we end up with a complex, I call it a zoo of hyperparameters. And this can be really challenging and takes a lot of time to get right in when we build our system. Reward function design is very challenging. And again, it depends on what type of trading style you want. You have to build your own different reward functions. So one of the most important takeaways from this is reinforcement learning is not a silver bullet. It's not something that you just apply and then you let it run and it will just automatically produce trading profits. We're not quite there yet. And we will probably never be there simply because someone else could come along, build this most intelligent machine and just performs better than your machine and you will just be losing. So reinforcement learning is a technique that we can use to trade on the markets, but it's definitely not a silver bullet that will just produce us highly profitable trading returns with us not doing anything or with us not putting much effort in. And finally, if you want to use this, I really, really encourage you to get good market experience. I call it also domain specific knowledge. Just being good at machine learning, in my opinion, is clearly not enough to produce profitable outcomes. If you really want to do this, make sure you really understand the market and you really understand what you're up against when you do trading.